Welcome to Closing Bell, live from the CNBC-TV18 Motilal Oswal studio. I'm Reema Tanuka with me because the day is coming to an end.
No, it is, and what a week we've had for the markets. What a day as well. We'll talk about it as we market firing away, IT and banks. So let's see what the next 60 minutes bring.
Well, until morning, until yesterday, it was such a range-bound, quiet consolidation for nearly a week. And suddenly today, you've got that breakout and you're...
The Nifty up close to around 1% odd. The only niggle today is maybe, in fact, your portfolio is not feeling so good because the mid-cap index is doing a relative underperformance. But as Reema started off the show with good,
day's high is almost 24,600. Not quite. I mean, the exact number is 24,592. That's been the intraday high today that we've hit. The bank Nifty has not made a fresh high, but nonetheless, it is TCS all the way. What a powerful move. Not just on that stock. It's not about TCS and one company's performance. The street wonder whether the worst is indeed over, if there needs to be a change in positioning, a lot of portfolios are overweight on IT, whether there needs to be a bigger tectonic shift. Look at what this has meant for HCL Tech Mahindra. I'm not reading from the IT index, I'm reading from the Nifty top. You can bring up the mid-cap IT names just for reference. Coforge, you've got Memphis, that have chipped in. I mean, as if banks and IT were not enough. Today, Reliance is in the green, doing really well. There's Lever, good-looking screen.
Well, Reliance is at the day's high right now, so 1.7% up. Perhaps the wedding, so it's lagging the frontliners. Even the advanced decline ratio right now is in favor of the losing side. The Nifty sensex up nearly 1%. The mid-cap index is just up close to about 3.5%. So that has been steadily climbing higher. And on
up move. And in fact, if you're not factoring in any kind of shocker coming from the budget, then we should have another couple of percent. If you're holding about those levels, so some of the shots will get squeezed out as well, which actually is a good thing. From the broader markets moving higher as we speak. Well, how do you position yourself in the final hour of trade? Mitesh Thakkar is back with us. What do you do from here?
Yes, I think, today, the Nifty is at least beyond 24. With the TCS number, a lot of stocks today open with a gap. We had a buy on Wipro, a lot of buying IT stocks and, trying to find some short on the trading the index. The only good thing which now needs to be done is to trail your stop loss to about 24,380, Nifty to about 24,800 odd level. So I think that's the target we'll work with. But in terms of tricky, and therefore I have a bias over there. On the stock calls as well, I would recommend a buy on Dr. Reddy's with a stop at about 6,600 for targets of around 6,920 to we can look at higher levels eventually. And Coforge has moved above the previous swing high. So that's a buy with a stop at about 5,920 for targets of 6,300.
Okay, let's talk about all these IT stocks. By the way, the Nifty IT index today has hit a fresh high. And this fresh high comes after nearly 2.5 years. The previous high on the Nifty IT was before the rate hiking cycle in the US began. The first rate hike in the US started in March of 2022. And just before that, the Nifty IT had topped. And after that, as the rates in the US kept increasing, the Nifty IT index started declining. And then even earnings came under pressure. But now the question is, will that tide reverse? So the Nifty IT after 2.5 years has hit a fresh high. TCS is leading the gain in terms of frontline pack. One, because the Q1 numbers were a solid beat. Two, the stock is still not at its 52-week high. The 52-week high is at 4254, 1.5% away from that. Third, some upgrades are coming through. Jefferies has upgraded it and pegged the target price at 4,600. And they're saying TCS offers relative value. And they're saying that TCS historically always traded at a premium to the Nifty PE. Okay, the Nifty PE, the premium it used to trade was 39%. But right now, TCS was trading at a 29% premium. And therefore, there is relative value versus the Nifty. But, I want to talk about some of the other mid-caps which are shining. One is Coforge, which even Mitesh picked up. That's up 8%. Emphasis is another one. These are stocks with very high BFSI exposure, banking financial services. We've picked up three, Coforge, Emphasis, and Oracle Financial Services, which is a pure, banking product company. Now, TCS, after 5 quarters of a revenue decline, quarter on quarter, this quarter showed a modest recovery. And therefore, there is a positive read-through for mid-cap companies where there is a high BFSI exposure. Now, all eyes will be on HCL Tech today. But next week, LTI, Mindtree, Infosys and Wipro will all three report their numbers. That's the calendar. And Wipro is the stock you should watch out for because in the last 1 month, the stock has gone up 28%, outperforming peers. And another mid-cap that we'd like to highlight is KPIT Tech. Remember 2 days back, Tata Elxsi came out with the numbers. It was a mixed, decent set of numbers. But what stood out in KPIT Tech was the auto vertical performance. But for Tata Elxsi, auto contributes only 40% to its overall revenue. But the auto vertical contributes 100% to KPIT Tech. And therefore, there was a positive read-through for KPIT Tech. But since the mood on Thursday was very downbeat, KPIT Tech didn't react. But today you are seeing that up move coming through on KPIT Tech because the auto vertical continues to see spends, which is where KPIT Tech is present. But we've got, before we go across to Prakash, listen in to some of the key, takeaways from the top TCS management when we chatted with them earlier today.
FY25 is still whole will be better than FY24,
right.
And we are quite comfortable with that. And see, what we are not be able to see much of a change in customer behavior in this quarter compared to the last quarter. They are looking at cost optimization, opportunity to do more conserve cash, and if there is a continuing trend towards looking at the ROI, so all those none of those factors have changed. Pick up in work in deals like BSNL is definitely one factor. The second is not necessarily the discretionary spend, but more cost optimization spend also. That's as an increase. So both together is what is delivering this.
All right, that was K. Krithivasan earlier outlining what he sees ahead, what his team sees ahead, saying that, yes, this year is going to be better than the last. And yes, a lot of the different verticals for the company, different geographies are firing. But at the same time, he's adding that caveat that customers are still cautious. Prakash Diwan is with us on the show. It's a Friday, so as usual, great to have you with us, Prakash. Let's start with this, massive IT move that we've got. I guess, the street really hoping that this is not just a TCS-specific show. This is going to be a show for the overall sector. Do you think it could play out like that? And if you were to add more money to IT, which stocks would you pick?
Good afternoon, Sarvesh. So, TCS always sets the trend, even if it may not be the top pick for most of us, given that it's well priced or fully discovered in most of its parameters. I think what was missing was, the sector leadership was missing in terms of, something demonstrating that there's a turnaround underway. And if TCS flags this, the kind of body language, the confidence that the management has, some of the metrics that have, fundamental metrics that have started showing improvement in terms of recruitment and all of that. And there's an all-round, sense of turnaround in all its verticals. So if that is the case, and if this gets seconded by HCL Tech, which I don't expect, but in case HCL Tech surprises us on the upside and then follows up next week with some of the other names, then you have the ball rolling for the sector as a whole and the re-rating would begin. But honestly, it's a bit too early to play the bugle and say, okay, everything's going to be back to normal, back to its glory days. So let's wait for some of the other numbers, some of the other verticals to demonstrate the kind of leadership that you would expect, and then you do it. But BFSI seems to have got its mojo back, and that's precisely why you have all the focused BFSI players. And as Reema pointed out earlier, the Bernstein report highlighted the auto-focused names like KPIT, Persistent, they've kind of, also perked up. So it's all around excitement that things could look up in most of the subsectors. But we'll of course have to wait. We're not picking anything as of now in a hurry.
But sorry, go ahead.
Between these two, KPIT as well as Tata Elxsi, what's the preference? Prakash, I ask you this because at around 1,000 rupees, I would have asked you about KPIT. People have said it's already expensive. 1,200, 1,500. Now it's on the verge of going to 2,000 rupees. So clearly the street believes that this niche that they have with regard to the transport vertical, it has a longer runway. And from Tata Elxsi's numbers, well, we clearly got that takeaway because the largest segment of theirs grew by more than 5% on a constant currency basis sequentially. Your view between both these two, KPIT as well as Tata Elxsi?
So, Nigel, that's a tough one, given the fact that valuations are stretched in KPIT, though there is salience in the underlying industry. Whereas Tata Elxsi is much more balanced in terms of its revenue streams. But, what is it that's going to contribute to it making it better or it more resilient? That's the question. But if you wait for, KPIT, of course, we haven't seen the recent numbers, but Tata Elxsi very clearly has demonstrated that it'll probably come back in terms of, its higher valuation bank. So there's a P re-rating that would happen, while the EPS would kind of start inching up also in the subsequent quarter. So I would probably believe while KPIT Tech has outperformed, it's Tata Elxsi which I would want to choose given the upside potential. KPIT, in my view, is going to face the resistance of being fully priced on most of the good stuff. Of course, there are a lot of these tie-ups that they had in the last 1 year, like the Honda tie-up and all, which still have to pan out. They've done well with the Volvo tie-up as well. So there's lots that's in the making, but I think it's all priced in. It's Tata Elxsi which would probably give you a little bit of a more comfort on the upside.
I just want to put out some interesting analysis. So IT stocks are very levered to the global interest rate cycle. So when interest rates globally go up, IT stocks, because they're cash rich, tend to underperform, right? We saw that. And this is what happened in the interest rate hiking cycle which took place. So Indian IT topped out in January of 2022. The first rate cut came in March of 2022. So basically IT topped out just as the expectations were going up that we've started the rate hiking cycle. After that, over the next 18 months, the IT stocks declined by 35 to 40%, but the EPS downgrades were only 3 to 5%, right? The EPS downgrades began 1.5 years later. So first, it's the turn in the sentiment. So now analysts are pointing out that are we at the mirror image, which basically means that in the next 18 months, slowly interest rates start coming down, but IT stocks do well, but the EPS upgrades are not going to be visible. The EPS upgrades will only kick in 2 years back. We are going to do the mirror image of what happened from January of 2022 to, almost June of 2023. When, so it's, IT is very, very sensitive to the global interest rate cycle. So that's something important to watch.
Okay, so that's IT. Well, for the time being, we have to move on to something else, something new. And this is a major development coming through. Adani Group's Vrinium International Seaport commenced operations yesterday as India formally welcomed its first cargo ship at the semi-automated transshipment port. Our colleague Vivek caught up with Adani Ports and SEZ's Executive Director Karan Adani. Let's listen in to some excerpts from this conversation.
This is one of the most strategic port, not just for India, but when you look at this whole region of South Asia. And we are very confident that this port will help in reducing the cost of logistics for our importers as well as exporters of the country, and help in improving the manufacturing base and making it more competitive at the global scale. As you know, that most of the transshipment volume in India gets transshipped either at Colombo or Jebel Ali or Singapore.
Right.
And our idea is that to bring that cargo back into India and get it transshipped and make India a hub, and rather look at reverse I would say transshipment, where other countries' volume should be coming here and we should be doing transshipment over here. And we are very confident that this port today, it's at 1.5 million TEUs, so roughly 18 million tons of handling. We would take this port up to almost 5 million TEUs. That is roughly almost 60 million tons, and it will be a big boost towards the growth of our overall portfolio as well.
Understood. What is the total capex that's been spent on this particular port so far? How much further capex do you envisage, and when do you expect operations to stabilize over here?
Sure. So total capex between APSEZ and government put together is 8,800 crores. Our share is roughly 3,600 crores for the phase 1. And going forward, the whole master plan, which we have committed to complete by 28-29, we would be spending additional 20,000 crores to complete all the 4 phases.
You have quite a few ports in your portfolio, both domestic as well as international. How is this port different from those ports that you have, especially when you're talking about Mundra and some of the ports that you have abroad as well?
Sure. So this port will be a pure international transshipment. And also with the rail connectivity and road connectivity coming in, we do expect that South India volume this port will become the gateway. more importantly, this will allow our customers, container shipping lines, to create a network in India using this port as a hub, not just for Mundra, but whether it's Mundra, whether it's Hazira, or on the eastern part of the country, that is Dhamra as well as Gangavaram, Krishnapatnam.
Industry reports, feedback indicates that there's significant congestion both at Colombo as well as Singapore. So number one, how much volumes do you expect to take over from there, and how do you compete with them in terms of tariffs? Is there a tariff differential that you could share with us?
So, as you rightly said, there is enough congestion in both the places, and we do see that there is a capacity constraint globally right now, especially at the transshipment hubs. So we are not looking at any discounting or anything, but we are looking to be competitive with Colombo as well as Singapore, and rather play on our strength of having larger efficiencies and productivity and giving better service to our customers.
One more question. In terms of international operations, you have quite a lot, especially with the Haifa portfolio. What are your plans in terms of international operations? Have you identified any other ports or any other regions that you would like to cater to?
Yeah, so our strategy is to look at this region. So we have a Bay of Bengal strategy and Arabian Sea strategy. So look at countries on eastern part of Africa, look at Middle East, you look at Sri Lanka, Maldives, and on the other side you have Bangladesh, Cambodia, Vietnam. So these are the regions that we are looking at, and basically looking at high growth countries, either with large manufacturing base or with high population, so there is a high consumption.
Tell us about your plans for Adani Logistics. How do you plan to capture further market share over there, especially in terms of rail logistics? And the second question, because we are short of time, in case Concord does come up for bidding, as of currently, it appears as though the divestment of Concord is on the back burner, but would you be interested in acquiring Container Corporation?
Concord is definitely a very strategic asset with the kind of positions and the ICD locations that they have. And I think it definitely adds a lot of value to our overall portfolio. So at the right value, we would be definitely looking at it, and we would be considering it. Apart from Concord, that doesn't mean our plan stops. So we keep expanding our footprint. We are as of today implementing 3 new ICDs within the country, and we will look at keep expanding our footprint. And that is how we are looking at. And one of the other things that we are looking at is giving last mile delivery to our customers. And so basically not just giving port service, but port, rail, ICD as well as last mile, and giving a bundle service, so a single rate to our customers for end-to-end delivery.
One last question. Any change in terms of guidance after this particular port has come into operation? So FY25 you have around 460 to 500 million metric tons as the target. Would you be upping that? And no. 2030 as of now, it remains
no change in current guidance, but yeah, 2030 we remain as we aspire to reach 1,000 million tons, 1 billion tons of volume handling.
Well, Karan, Adani asserting that they're not going to be changing their guidance as of now, but they're sticking to it. And also importantly, the comment that he made on Concord with regard to the interest that they have out there, that's clearly had an impact on the Concord stock price. It's moved to the high point of the day. I think we should pull up the intraday chart out there. We should get that line back up with regard to his comment on Concord. That's the one. It currently has spiked up to the high point of the day. Let's get that line up. Concord is a very strategic asset. It will add a lot of capacity to our portfolio. That's the line that did come in, and they'll be interested, but at the right value. Street has read that positively, explains why the stock from trading in the red has now reacted to that piece of news, spiking up to the high point of the day. For the time being, we slip in a short break. On the other side, we have Sanjay Parekh of Soham Asset Managers, who's waiting for us. He'll give us his call on markets and individual stocks and sectors. Welcome back. Markets holding with a gain of close to around 220 points. So good going out there. Couple of stocks though are seeing some kind of selling, and I want to just point out Kotak Mahindra Bank. That one is down close to around 0.5% now, but the entire fall has come in the last few minutes. You also have HDFC Bank that's struggling to hold at higher levels. It's hovering around the 20 DMA. If you pull up HDFC Bank and you pull up the 20 DMA with it as well, you'll see it's hovering around those levels. It's not able to get decisively past that level. So that's going to be a near-term technical barrier that we're looking at for HDFC Bank. So keep an eye out on that front as well. And ICICI Bank has slipped a little bit. That's what I'm talking about. HDFC Bank a little below its 20 DMA and ICICI Bank. So the banking index itself has slipped 120 points because of these heavyweights moving a little bit lower. But let's get straight to the chat with Sanjay Parekh of Soham Asset Managers, who joins us on the show. Hi Sanjay, good afternoon and good to see you. And first of all, congratulations. You and your team have had a good last 1 year run. I was just looking at some of your peers as well. And you all have done well. So kudos to you all, and I'm happy for your investors as well. But let's discuss about the way ahead. I recall the last time we chatted, you were talking about a bit of an relative underweight stance on the tech space. But you're at increased weightage, but still in comparison to the benchmark, a little bit lower. What's the current view on the IT space? We've got TCS, we had Tata Elxsi that came out with set of numbers. And the street believes that the worst is behind and things will look up from here on. What about you?
Yeah, so Nigel, this is how we think about it. I mean, last 2 years, we had significant underweight on IT. And, just last month, we felt that, while growth this year will be lower and this is not going to be a great year, while it may recover a little bit. But, from here on, when you look at markets and the valuation, and then when you look at tech for the higher return ratios, with a low FY25 growth rate, but 26, if things get better, in sync with the lower interest rates that Fed is talking about, then, while the visibility on 26 is still low, but there could be a case of making 13 to 15% return with dividends. And that's where we reduced our underweight, and that's where we invested in 2 of them. But we are still underweight. So, as I said, that we still feel that, overall growth this year is going to be, I'm talking of broader growth will be lower. Certain companies may do well, which are mid-sized companies, which are into niche space. But otherwise, this year is going to be tough. So we're going to be still cautious, but we've increased our weight in the last 1 month.
Did I catch you saying that you have 2 stocks that you own in the tech sector? Which ones?
Yeah, so we own Infosys and HCL Tech, both of them. Okay. We don't have any mid-cap IT company as yet, but these are both where we've increased our weight last month.
Okay. Why not Wipro? Because in the last 1 month, the dark horse which has performed very well is Wipro. Since June, the stock is up 28%. So valuations were reasonable relative to peers. So when you had to pick, why not a Wipro? What worked against it?
I mean, clearly, yes, it's done exceptionally well. Of course, again, we saw their leadership transition. And, at times when there is a transition, Wipro is a great company. Absolutely no doubt about it. It's just that if you take the last 10-year growth rate versus the larger peers, it's been weak. And then we saw a leadership transition. So it could be both ways. One can look at it positively, but it can even be, taking them more time. So while valuations were comfortable and hence you saw it significantly outperforming from a lower point, but we chose to invest in another 2 where we are comfortable in the leadership in both the companies.
Sanjay, hi, good to have you on the show. So, as I can see from the document here, some of your biggest overweights continue to be from the capital goods space and I think even construction. So basically the economy facing side of the market, right? So what gives you the comfort? And I just want to understand the profile of stocks. I'm not sure, I don't have the stock specific list here. If you could tell us, that'll be helpful. I just want to understand whether you'd be okay owning the likes of an ABB or a Siemens, which are now trading at 80-90 times forward earnings.
No, that's not our style, and we missed out also at lower levels. our average price earning of a portfolio is 16 times, and we almost shiver when there are price earnings of 60, 70, 80 times. And some of them from 60 times, they've gone to 100 times or 90 times. I mean, they're great companies. And as I said, we missed out. But, we will play our style. And also introspect that where could we learn. But we don't own them. And we, of course, own Larsen and Toubro. And one of the companies in road construction, and one of them, of course, we disclose. So Solar Wilson is what we own, where we bought it way early, last 4 or 5 months back. And then overall domestic, we are positive. The whole auto ancillary space broadly neutralish, but we are positive on that, and at a price would buy in. Cement, yes, we are positive. We reduced recently, and that's a disclosure, our weight in cement because we thought that the valuations are really, really rich now. So we are overweight, but the degree of overweight we've reduced. We raised our cash this month, and our own stocks we've reduced our weight where we think that they run up too fast. And this is even, as I said, in one of the metal companies, on cement we reduced our exposure. We also reduced our exposure a little bit to telecom. So that's where we are right now. But overall domestic theme. Domestic overweight and global underweight is what we've done over the last 2 years, and it's worked.
Okay, all right. Okay, domestic positive and global underweight is the way you all have played it. Got it. Sanjay, I also want to ask about the transportation space. We just had a bite coming in from Karan Adani, and he's saying that on Adani ports, well, he believes that guidance is very much gettable. And he also said that maybe they could be interested in Concord at the right value. That's one of the stocks that's done very, very well. And I think on transportation, you'll have a relatively higher weight in comparison to the benchmark. You'll have Adani ports, you'll have delivery as well. Tell us more about that. You've gotten at the right price. What do you do from here?
Yeah, so I mean, it's been, we made 100% plus return in the stock. This stock I've been following now for 12, 13 years. And you've seen the transition of that company from, less than 100 million to now 500 million tons that they will reach, and then moving up to 1,000 million tons. It's pretty large. It's absolutely a great moat. And then they're moving from just a port company to an end-to-end services company. And clearly the whole, the ports, if you see the map of India, they almost covered a lot of it in terms of, they're gaining market share. And of course, this is a very, very profitable business with margins at 68, 70% margins in the port business. And it's a moat which will grow at maybe 15 to 20% because they gain market share, and then acquisitions also help them. So it's a fantastic company which we will want to hold for a longer term. As I said that, there's a big operating leverage as well. Of course, always the valuations in these markets are not cheap, but that's what we think that, maybe 6 months, it's okay if it doesn't perform, if you have a horizon of 3 to 5 years. So we like the space. Delivery is what we own. The whole, the space, the growth is not great where delivery is positioned. So that space, overall sector growth is less, and hence it is taking some more time. But as a company, their execution, we are very, very positive. E-commerce growth has been laggard, that we've seen it, but they're very, very competitive, and we believe that they're gaining market share, fantastic technology, and we believe again, they have a critical mass size. They do 70 crore parcels. They've gained again market share. So we believe as growth comes back in the e-commerce segment, and even on the partial truckload segment, they will certainly benefit. But delivery is not done well in the last 1 year, but that's okay for us. We'll hold on for.
Sure. You're saying 3 to 5 years. I hope people are listening to you and people who are coming into this market right now. If they can have that kind of a view, I think it'll be a lot safer, right? Just before we let you go, Sanjay, you mentioned that you're also raising cash levels. I think you're around 6% now in terms of cash.
Yes, we were at 6%. We've further raised now. We're almost at 10% plus. I mean, normally
Okay.
we exceed 10%, but in the interim we'll correct it. But we are almost. We've raised our cash and we book profits in our own stocks. We believe that there is froth even in the stocks we own, but I'm saying they're overvalued and not say froth. And hence we've reduced our weight to some extent in materials, steel, metals, and even in telecom. So that's how we think about it.
You're okay to hold it, Sanjay, because I don't know. I mean, I think a lot of managers are looking for that dip where they can deploy cash. Yesterday, we were talking to the managers at PPFAS. Their cash levels have risen to almost 16%. So I don't envy your position really in a market like this. But then what's the way forward? I mean, where would you deploy if you start getting one of those odd drop days?
Yeah, so we have a mandate. We say that we don't take cash calls, and we will. So we said we will not exceed 10% on a secular basis. And in case of extreme froth, we've taken a permission to go to 15%. But that's it. We don't believe that we are in any such stage to raise cash. That's our view to a big level, at least in the larger cap space. It is overvalued, and maybe we could see 3 to 5% correction. But for that you don't raise cash. So in larger caps, I think it could be 3 to 6 months of time correction, 3 to 5% of price correction, and it's done. So it's not something that we are in a ballooning stage. In mid and small cap, yes, we are very cautious. There are elements of froth, and we stay away with it. But at the same time, we have one of the companies, you get opportunities in mid and small cap. So you have to look for them and cricketing terms, play a loose ball, not play all the balls and you get out. So you just play a loose ball and you wait for the right stock. And invariably every month, in larger caps also you get opportunities, So I can tell you 6 months back, HPCL, BPCL were at great bargains. 3 months back, Indus Tower came at a great bargain. Earlier, Kotak, which had a temporary issue, you got it at a good bargain. And so on in the middle, the non-ferrous space, we all have covered well. Vedanta came at a very, very good level. So each of the larger cap stocks also you get opportunities. You just have to be a little contra in your thinking. And as I said, play a loose ball. And in mid cap, small cap, be more cautious. That's our strategy.
Sanjay, great conversation. Thank you for joining in and enjoy your weekend. Need to get into that break. As always, we'll get you a check on what dealing rooms are saying in our segment D Street Chatter. PTSD calls coming in also.
Welcome back. You know, the stock of the moment has to be Oil India. The stock was higher yesterday, but just in the last 10 minutes, the stock has moved 10%. No, I'm not got it wrong. It's moved 10%. It was up close to around 5%. Now it's up close to around 15%. And it seems it's moved, at a very, very brisk pace. I'm not sure whether there could be a big short covering bounce actually that's taking place on this one. Let's pull up the futures plate. The stock in the cash market is at around 632 approximately. But let's pull up the futures plate as well and see what's going on that front, because this is a very, very sharp move that we're seeing on that counter. The futures plate will come up for us at some point of time. For the time being, not a bad idea to get in Nimesh, who told us earlier about the Oil India stocks. We'll get to that in just a bit. But Nimesh, for the time being, tell us what you're picking up in D Street Chatter.
Well, from a market point of view, it's all about IT, and IT. Across the board, whether it's large cap IT, mid cap IT, small cap IT, all are buzzing after a very strong number from TCS, and that's actually led to a big outperformance for the Nifty. On the other side, the broader markets are relatively underperforming. So at a portfolio level, I'm not sure everybody's so happy about today's record highs in the Nifty and in the market. Even from a flow point of view, it's been pretty much mixed, but I understand there are select sell flows into especially PSU bank names at a leading FIR desk today. So that's from a flow perspective. In fact, there's going to be a small MOC as well, is what I understand, in some select stocks. So that might have an impact on some select names. But broadly, the sense is, while the Nifty has hit record highs, today is largely the large caps and the IT which has helped. But at a portfolio level and in the broader markets, there is a bit of underperformance and a bit of profit booking as well.
Yeah, absolutely, because at the mid-cap index level, things are a little quiet. Got that, Nimesh? It's really all about IT, right? What about stocks? What are you hearing specifically?
Well, as I said, there is selective buying in MOC buying and selective buying in some names. So the first stock is PVR. That's after a long time we're seeing some bit of buying interest, and that's buzzing largely on the back of strong buy flows. So expect high delivery volumes there. The second name is Birlasoft. I spoke about IT as a space doing well. Birlasoft stands out and largely on the back of HNI flows. So it's not like largely institutional driven, but a lot of HNI interest seems to be back in Birlasoft at these levels. The third stock is Kalyan Jewellers. Again, the stock has been consolidating at record levels. But there has been selling pressure from larger FIs for the last couple of days, and that stands in today's market as well. So while there is a bit of momentum in the Nifty and large cap names, Kalyan Jewellers has seen some bit of selling pressure today. And the last is Genius Power. Again, almost at record highs. The stock has been a big mover in the last few months, but now the street is anticipating a large order win for the company very soon. So that could be the next big trigger for Genius Power to outperform.
Okay, got it. So those are all the stocks in focus. Thanks, Nimesh, so much for that. By the way, look at the Bank Nifty once again, and this is the problem with the market. There is absolutely no consistency in the way a lot of the frontline banks are performing, and things were going quite okay for the market, but the Bank Nifty has given up, and it's HDFC Bank that's seeing the bulk of that downward move. ICICI Bank is also now struggling, but it's sort of a gradual decline, and now we've got a bit of a red on that index. So that remains a bit of a disappointment. Kotak is also losing ground. But HDFC Bank and ICICI Bank, these are the big ones as we start sort of getting into the final leg of today's trading action. Guys.
Well, I want to talk about Oil India. That's the one which is up 15%. Nimesh, you were talking about this. Morgan Stanley has turned more bullish on Oil India. That was a standout brokerage report of the day also.
Well, absolutely. So, as you rightly pointed out, Morgan has put out a note today morning. In fact, they have a tactical buy as well for the next 30 days. So maybe that explains a big move on that name. So from a report point of view, they've raised the target. They were having an overweight stance, but they've raised the target price now to 663. I think the stock is almost at those levels now, all the way from 496 earlier. Now, a couple of reasons why they've turned very bullish on this particular name. One, the gas production has doubled in the last 4 years. The capacity at their most profitable fuel refinery in Asia, that's tripled in the last 4 years as well. In fact, the company has a 38-year of hydrogen reserve life monetization. So that's going to be a big kicker for Oil India going forward. And the company has reported 14% CAGR in terms of operating cash flow for the last 4 years. Having said that, despite all this numbers, the stock is still trading at single digits, which is around 7.5 times on FY26 estimated price to earnings. So that's been the kick, a big reason for a big upgrade there. Again, the company has got a very good dividend track record as well. So that's positive. And also, Morgan Stanley believes that over the next 4 years, so by 2029, the earnings are going to double as well. So that again is going to be a big trigger, and that's been largely underappreciated by the market. So that was a key reason for Morgan to go ahead and further raise the target price. and turn more bullish, but they believe that earnings can double in the next four years from here.
Okay, thank you very much for that. Mitesh is back with us for a few BTST calls for the weekend. Mitesh, what do you have?
So, earlier I was talking about the fact that the bank nifty and the rest of the market is not participating. And I think, that's still playing out. And that's why I said keep the focus only on IT stocks. I'll take a BTST on HCL Tech. Keep a stop at 1550, look for targets of 1585. While Indian Hotel will suggest a negative or a STVT kind of a call with a stop at 600 for targets of 582.
Okay, talking about HCL Tech, remember it will be reporting numbers. The press conference is scheduled at 6:15. So typically the numbers come out prior to that, about 30 minutes prior to that. In terms of expectation, the expectations are muted because this quarter, one of the large projects had gone offshore. So the company will be earning less on account of that. And also they'll pass on some of the productivity benefits. Basically, as the deal becomes, as you earn, it's sort of like a discounting because you get more productive. So those benefits are passed on to customers. So you put all of it together, we're working with a 2% drop in the company's top line, but it's sort of guided by the company. They had indicated this. Margins will also decline despite no wage hikes because of the revenue compression. EBIT margins seen at 17%, down 60 basis points. Profits down 5.5%. We expect the company to maintain its full year guidance of 3 to 5% on the top line, 18 to 19% on the margins. But, there are skeptics on the street who believe that it's going to be hard for HCL Tech to achieve this guidance. So I think there needs to be some, commentary from the company on the comfort in achieving their full year guidance and also the outlook on deal wins, because last year was fairly subdued in terms of deal wins for HCL Tech, X of the large Verizon deal. So how are the deal wins? The street will watch very closely. But I think, TCS's numbers have fired up the street's expectations. The stock is down well today. I think it's up close to about 3% in anticipation of the numbers. So it's going in strong. So any disappointment compared to the estimates might be not taken so well by the street.
Okay, all right. So we're going to watch out for those numbers as they come through after market hours. Now, HDFC Life will be reporting Q1 numbers later this week. We have Yash with a quick preview.
Well, Surabhi, before I talk about what's expected out of the numbers, it's important to see how the stock has reacted in the last 3 months. So largely, it is where it was 3 months ago, hardly moved. It's about down 5% in the last 1 year, flat in the last 6 months, and just up about 3% in the last 3 months. The stock trades at lower valuations at this point of time at about 2.2 times price to embedded value. Now, if we speak about the numbers, it's going to be an improvement when it comes to the top line, that is annualized premium equivalent. But the margins are going to see some compression, and that is because of the increased ULIP portfolio for all life insurance companies, including HDFC Life. So your new business premium, that is expected to grow by about 11% in the first quarter, coming in about 6540 crore rupees. Your total annualized premium equivalent or total AP is expected to grow by 22%, coming in at about 2846 crore rupees. Retail AP expected to grow at 30%, coming in at about 2453 crore rupees. Finally, value of new business is expected to grow by 20% at 730 crore rupees. And as I said, margins are expected to see some compression because of the growing ULIP portfolio. So margins expected to see a compression of about 56 basis points to come in at about 25.64% versus 26.2%.
All right, got that. Yash, thanks very much. We'll watch out for those numbers as well. For now, we have to take a very quick break. Come back with more market talk on the other side. Welcome back. 7 minutes to go, and we have Hemang Jani joining in to take us through the last lap. Good to have you with us on the show, Hemang. And what a end to the week this is turning out to be, right? Just when we needed some more inspiration, TCS has come in and delivered that. But what do you think? I mean, the kind of rally that's come in today, is it justified given the fact that while TCS has done really well, they've beaten estimates, they're still a little cautious in terms of that commentary?
Yeah, good afternoon, Surbhi. I think what a day to end the week, and we are closing at all-time high levels, and the large cap IT companies like TCS and many more are up anywhere from 3 to 7%. So that surely has boosted the sentiment for the IT sector as such. And what we feel is that you need to really see how some of the other companies are delivering the numbers, and more importantly, what sort of growth and vertical wise outlook that they are delivering. So at this point of time, given the numbers and the movement that we have had so far, we would be more inclined towards some of the mid-cap companies, particularly in certain domains where the growth outlook could be better. So something like a Zenser Tech or a Sonata Software, Birla Soft, Mastech. I think these are the companies where we more comfortable with in terms of taking new exposure, but a larger commitment should be taken once the numbers are out.
Okay, fair enough. That's the sense on IT. Hemang, tell us, it's the hardest thing in this market to find fresh new buying ideas. But you tell us, I mean, any names, something that one can work with?
Yeah, it's been tough, I think, given the way the market has moved and, the sector rotation that we have seen, it is becoming harder by the day. So I think still, if one has to choose the pockets, we would be more, comfortable buying into some of the upstream oil and gas companies. Maybe, something like ONGC. Oil India has seen a big move today, but, in terms of valuations, in terms of growth triggers and dividend yield, still, I think it is looking quite attractive. Apart from that, I think FMCG certain pockets be very comfortable with, particularly something like a Britannia, where we are expecting, decent numbers in terms of volume growth and margins both. Demand, it's something that we've been liking. So I think one will have to really, work a little harder in terms of identifying the companies with better growth prospects and valuation both. But there are certain pockets where one can really look at.
Okay, so looking at some of these FMCG names, got it. That's one idea. I'm sure you're looking at the breathtaking moves on the railway side, right, Hemang? Whether it's RVNL, Aerocon, IRCTC, rides. It's just, completely shooting high over there. Where do you think our earnings, maybe to an extent at least, justifying these kind of price moves that we've seen? Would you buy anything afresh, or is there anything that you'd still recommend people keep in their portfolio? If not a fresh purchase, but at least something that can be at least held on to.
So I think the entire move that we are seeing in certain PSUs, be it railways or defense, I don't think people are looking at the quarterly numbers. In fact, if the quarterly numbers are out, it can give a bit of a reality check for some of these companies which have gone up by 10, 15, 20 times. So I think from a theme perspective, if really somebody wants to be in, let's say, a railways, maybe something like a BML or Titagar is something that we have as a part of the core portfolio. But I don't think, one should be too, excited about the numbers or, the overall growth that one is really looking at least from a near-term perspective.
Okay, I'll tell you what, we're doing, of course, a lot of the stories in the run-up to the budget. I just want to point out one that our colleague Sapna had picked up. Maybe we can get the graphics up. And this pertains to certain demands that city gas distribution companies are putting forth ahead of the budget. They are seeking an intervention to become price competitive versus certain other fuels for transportation, LPG and EV. And they're saying that basically VAT rates are resulting in a lot of cost escalation, which makes perhaps CNG non-competitive vis-a-vis some of the other fuels, particularly on the EV side. And the example they're citing is, for instance, UP is levying 10% VAT on CNG purchase without any input tax credit. 12.5% on CNG. Basically they're saying that we need some tax incentives to remain competitive. This is what Sapna had picked up earlier. Hemang, your thoughts on city gas distribution companies? Some of them had hiked prices just, earlier in the week. What's your stance? Do you like anything over here?
Yeah, so I think we have triggers in the short run. Because of the fact that there is a possibility of this space getting into the GST framework, and thereby there is be a certain amount of benefits that these companies would stand to get. That's number one. Number two, you had this Bajaj Auto launching the CNG bike, and to some extent, while people were worried about the possible impact on volume that's EV could have, I think a part of that is going to be mitigated, and you will see a little bit of upgrades come through. And now we are seeing that while the spot prices of CNG have gone up, because of the price hike that the companies have undertaken, the margin picture will remain stable with a 5-6% kind of a volume growth. So all in all, we do like the space. I think both MGL and IGL are the companies that we are comfortable buying even at this point of time.
Got that. All right, Hemang, we will wrap it up on that note. We're running into the market close now. You have a great weekend, and we look forward to connecting again soon. Well, down to the final rates then, and it's a very split screen, you'd have to say. It's IT to the rescue for the bulls, really, with the Nifty hitting a fresh intraday high today, and the close is going to be above 24,500. That's almost 200 points higher. Look at the charge of the Lightning Brigade. TCS 6.5% higher, Wipro 4.5%, Infosys, HCL Tech, Tech Mahindra, LTI Mindtree. All of these are your top batsmen, and all of them coming in from the IT space. They have a good company in the form of Reliance, up 1%, L&T, which is going to close up about 1% as well. Some buying on names like Tata Consumer, on HUL from the consumer pack. So overall, looking pretty good. Now, the issue was the volatility in the banks. The Bank Nifty turned negative just about 10 minutes back. Now it's again positive. You have some of the names like HDFC Bank, which are back on the positive side of the screen. I mean, the intraday charts are all over the place for these bank stocks. So for what it's worth, we've got about a 60-point up move on the Bank Nifty as we're closing out. Look at some of the others. ICICI Bank still in the red, and State Bank of India up about 0.5%. So very mixed on banks. The weak hands on the Nifty included some of the names from the auto space. Maruti down about 1%. Asian Paints, Divi's and Titan were some of the other weak performers, cuts of about 1% each. Today was a very quiet day for the mid-cap market. The mid-cap index has underperformed the Nifty quite a bit, a cut of about 33 points. And an advanced decline ratio which is also negative. But having said that, I mean, you still have the high flyers and a lot of the PSU names once again. Oil India, 8%. Railway stocks like IRFC. You've got, of course, Ircon, about 5.5% on the upside. Railtel, 15%, looking good. And then, of course, let's not forget mid-cap IT as well. I mean, not to be left behind at all. Something like a Zensar, Persistent. Lots and lots of names. KPIT Tech about 9% higher, Coforge 8%, big moves, Birlasoft 5%. So mid-cap IT, large-cap IT, IT and IT. That is what this Friday was made up of, courtesy TCS. Well, the bell is gone. It's curtains on this edition of Closing Bell. Thank you very much for being with us, but don't go anywhere because our Friday special editors roundtable comes up just after this break.